Chemed Corporation just posted Q1 2026 revenue of $657.5 million, beating the $649.8 million estimate by roughly 1.2% on the top line.
But the headline misses the real story. EPS came in at $4.85 against a $5.30 consensus, missing by 45 cents, or 8.5% on the bottom.
This is the fourth consecutive quarterly EPS miss for Chemed. The pattern started in Q2 2025 and has persisted through Q3, Q4, and now Q1 2026 without a clear bottom forming.
The stock reflects that pressure. Shares trade near $383, close to the 52-week low of $365, down 34% from the $584 high.
Yet management is leaning aggressively into the weakness. Chemed repurchased $190 million of its own stock in Q1 alone, roughly 3.7% of market cap in a single quarter.
That capital return pace tells you how McNamara views valuation. Two businesses sit underneath: Vitas, the #1 U.S. hospice provider, and Roto-Rooter, the nation's largest plumbing service brand.
The thesis is a compelling long-term demographic story temporarily clouded by Vitas labor costs and EPS execution gaps. Today we unpack whether those clouds are cyclical noise or a structural concern for patient investors.
Chemed traces its roots to 1970, when it was spun out as an industrial chemicals business before evolving into the healthcare and services holding structure investors recognize today under ticker CHE on the New York Stock Exchange.
Headquartered in Cincinnati, Ohio, the company employs roughly 15,700 people across its two operating segments and maintains a disciplined corporate overhead relative to the two business lines.
Kevin McNamara has served as CEO since 1994. That makes him one of the longest-tenured chief executives anywhere in healthcare services, and his fingerprints are on every major capital allocation decision over the decades.
The structure is refreshingly simple. Vitas Hospice contributes roughly 75% of revenue, while Roto-Rooter Plumbing and Drain Services contributes the remaining 25% of the top line.
Vitas is the largest U.S. hospice provider by revenue. It serves Medicare beneficiaries at the end of life, with care delivered across homes, assisted living facilities, nursing homes, and dedicated inpatient units.
Roto-Rooter is the unquestioned national brand leader in residential and commercial plumbing and drain cleaning. It combines company-owned branches with a franchise network across virtually every major U.S. market.
Under McNamara, share count has collapsed from more than 30 million historically to roughly 13.7 million today. That is decades of disciplined, opportunistic buybacks compounding into real per-share value.
Q1 2026 revenue of $657.5 million exceeded the $649.8 million consensus, a 1.2% beat that confirms underlying demand remains healthy across both segments.
Year-over-year revenue grew 1.6% from $646.9 million in Q1 2025. Not explosive growth, but steady progression, consistent with the Chemed long-term compounding profile.
The 8-quarter trend shows steady expansion from roughly $596 million in Q2 2024 to $657 million in Q1 2026, with predictable seasonality in the middle quarters.
Q2 and Q3 typically run softer seasonally. Roto-Rooter benefits from cold weather plumbing emergencies in Q1 and Q4, while Vitas census patterns also skew slightly favorably into the winter months.
The top-line beat was genuine, but the miss was purely on the bottom line. Revenue is not the problem at Chemed right now. Cost structure and reimbursement dynamics are.
Vitas drives most of the beat whenever average daily census expands meaningfully. ADC is the single cleanest revenue lever in the hospice model, multiplied by the Medicare daily reimbursement rate.
Roto-Rooter delivered its typical Q1 strength. Burst pipes, frozen lines, and winter-related emergency calls drive predictable above-trend volumes across the national service footprint during the first calendar quarter. EPS printed $4.85 against the $5.30 consensus, a miss of 45 cents or 8.5%. The magnitude of the miss is the part that stings for holders.
This is the fourth consecutive EPS miss. Q2 2025, Q3 2025, Q4 2025, and now Q1 2026 have all fallen short of street expectations, and that kind of streak attracts analyst skepticism.
Net income landed at $66.3 million for the quarter. Operating income was $84.6 million, translating to a 12.9% operating margin on the Q1 revenue base.
The miss is mechanically driven by VITAS clinical labor cost inflation and lumpy Medicare reimbursement dynamics, including cap-related adjustments that can hit earnings in hard-to-forecast ways quarter to quarter. These are real headwinds, but they are not permanent structural impairments to the business model.
My forward EPS projection framework anchors on consensus estimates of $23.88 for FY 2026, $26.62 for FY 2027, and $28.90 for FY 2028.
Those numbers embed a meaningful acceleration curve. The core assumption is that VITAS labor inflation normalizes through 2026 and that Medicare cap headwinds stabilize as admissions mix and average length of stay rebalance toward historical norms.
Anchored against that forward EPS projection path, at $383, the stock trades at 16 times FY 2026 earnings, well below the historical 20 to 25 times range Chemed has commanded.
Investors are essentially being asked to underwrite a labor normalization scenario. If 2027 and 2028 EPS materialize as modeled, today's multiple looks undemanding for this quality of franchise.
Gross margin came in around 22.5% for the quarter, slightly below recent prior quarters, and reflecting the ongoing pressure from VITAS clinical labor cost inflation at the direct care level.
Operating margin of 12.9% and net margin of roughly 10.1% frame the story clearly. Margins are compressed, but they're not collapsing by any reasonable standard.
The compression is concentrated in VITAS. Hospice care requires registered nurses, home health aides, social workers, and chaplains, and every one of those labor categories sits in a structurally tight market.
SG&A held roughly flat as a percentage of revenue, which tells you management discipline on overhead is intact, even while direct care labor costs push through the P&L unevenly.
EBITDA margin sits around 15.2%, giving you a cleaner read on underlying cash profitability before non-cash items and reimbursement timing distortions flow through reported operating income.
Roto-Rooter margins are structurally healthier. It is a service business with pricing power, no Medicare reimbursement complexity, and direct consumer invoicing that reprices with local labor and materials inflation.
The margin question going forward is whether VITAS clinical wage inflation peaks in 2026 and begins to flatten, or whether staffing pressures persist and continue to weigh on consolidated profitability. Q1 operating cash flow came in at $88.2 million. Capital expenditures ran $17.1 million, producing free cash flow of roughly $71.1 million for the quarter.
But buybacks were $190 million. That is nearly 3 times the quarter's free cash flow, funded by existing cash and balance sheet flexibility rather than ongoing operating generation alone.
On a trailing 12-month basis, free cash flow runs around $377 million against a $5.14 billion market cap. That implies a roughly 7.2% FCF yield.
That yield is genuinely attractive for a business of this caliber and quality. You rarely see 7% plus FCF yields attached to market-leading healthcare services franchises with strong multi-decade compounding track records.
Cash on hand sits at just $17 million. Total debt sits at $237 million. The buyback machine is running hot, even as liquidity tightens on the balance sheet.
Management is making a deliberate choice. They view the stock at 52-week lows as the highest return capital deployment available, and they are leaning in with conviction rather than hoarding dry powder.
The risk is obvious. If Medicare cap refund liabilities materialize simultaneously with sustained heavy buybacks, the cash cushion becomes thin. But McNamara has navigated this pattern successfully for 3 decades. Cash of just $17 million is extremely lean by any corporate standard. Total debt of $237 million puts net debt near $220 million entering the current quarter.
Total assets sit at $1.54 billion, with equity of $848 million. Leverage is manageable, not alarming, and interest coverage remains comfortable given Chemed's consistent operating cash generation profile.
Current ratio of roughly 0.85 technically sits below 1. That is a flag worth noting, but it has been a deliberate operating choice at Chemed for many years running.
The balance sheet is not dangerous. Debt load is easily serviced by free cash flow, and the company has never faced a liquidity event despite decades of aggressive capital return programs.
Where caution is warranted is the interaction of a thin cash buffer with potential VITAS Medicare cap refund obligations, which can be lumpy, hard to predict precisely, and tend to arrive at inconvenient moments.
Chemed has operated with lean cash for years. This is architecture, not distress. Every dollar sitting idle on the balance sheet is a dollar that has not been returned to shareholders efficiently.
Still, investors should watch the cash line closely over the next 2 quarters. A sub-10 million cash print combined with another heavy buyback quarter would warrant real scrutiny on capital allocation discipline. The annual dividend runs $2.30 per share, paid as roughly 57.5 cents quarterly. At the current stock price, that translates to a dividend yield of roughly 0.6%.
That is not an income play by any stretch. The payout ratio sits around 12.5% of earnings, which is deliberately conservative and leaves maximum flexibility for opportunistic capital deployment.
The real capital return story is the buyback. $190 million in Q1 2026 is a staggering pace, representing roughly 3.7% of market cap retired in a single quarter.
Share count has compressed from more than 30 million historically to roughly 13.7 million today. That is one of the most sustained and disciplined buyback programs anywhere in the healthcare services universe.
At the current pace, another 2 to 3% of market cap could be retired every quarter if the stock remains near these levels. Compounding buybacks at trough multiples is powerful.
McNamara has effectively turned Chemed into a per-share compounding vehicle. Revenue growth is steady, but EPS growth is structurally amplified by the relentless reduction in the denominator over time.
For long-duration shareholders, the dividend is almost incidental. The real return engine is buybacks at low multiples, and Q1 2026 is a textbook execution of that playbook in practice. Analyst sentiment sits in mixed territory. Roughly 5 sell-side analysts cover CHE actively, with 2 buy ratings, 3 hold ratings, and 0 outright sell ratings across the current coverage universe.
2 notable downgrades hit the name in early 2026. RBC Capital moved to sector perform in February, and Jefferies cut to hold in January, both citing the persistent EPS miss pattern.
On the constructive side, Oppenheimer maintained its outperform rating, and Bank of America kept its buy call intact. Those bulls are pointing to the demographic tailwind and valuation disconnect.
The average price target across the coverage universe sits near $480. Against the current $383 stock price, that implies roughly 25% upside to target.
Interestingly, shares actually rose 2.6% on earnings day, despite the EPS miss. That reaction suggests the market had already discounted a weak print, and positioning was cautious into the event.
The setup from here is interesting. Expectations are reset low, sentiment is subdued, and the stock is trading at trough multiples, which historically is where long-term entries into Chemed have tended to work.
That said, another EPS miss in Q2 2026 would almost certainly trigger further downgrades. The patience window on Wall Street is narrowing, and the next print carries genuine rating action risk for the stock. VITAS contributes roughly 75% of revenue, translating to approximately $493 million in Q1 2026. It is America's #1 hospice provider by a meaningful revenue margin over competitors.
The revenue model is straightforward in structure. Average daily census multiplied by days of care, multiplied by the Medicare daily reimbursement rate of roughly $200 for routine home care.
Key operating metrics to track are ADC growth rate, admissions growth, average length of stay, and Medicare cap utilization. Those 4 inputs drive almost all of the segment's revenue and margin variability.
The demographic tailwind is enormous and durable. Roughly 10,000 baby boomers turn 65 every single day through 2030, feeding a structural expansion in the eligible hospice-utilizing population base.
Hospice utilization among the 80-plus age cohort is also rising structurally. Cultural acceptance of end-of-life palliative care continues to broaden, which expands the addressable market independent of raw demographic growth.
Roto-Rooter contributes roughly 25% of revenue, around $165 million this quarter. It is the national brand leader in plumbing and drain services across residential and commercial markets.
Residential emergency work is non-discretionary. When a pipe bursts, a homeowner calls immediately, which gives Roto-Rooter strong pricing power and revenue per job growth running comfortably above general consumer inflation.
Q1 seasonality is favorable due to winter-related pipe issues. Roto-Rooter's franchise plus company-owned structure gives Chemed durable, cash-generative, non-discretionary revenue that nicely cushions VITAS reimbursement volatility, providing a reliable earnings floor regardless of the hospice reimbursement environment.
The bear case starts with 4 consecutive EPS misses and no clear bottom yet in sight. Pattern persistence at this point raises legitimate questions about forward earnings power and guidance credibility.
VITAS Medicare cap dynamics are genuinely difficult to model. Care delivered above annual per-patient limits triggers refund obligations that hit EPS in lumpy, hard-to-predict ways across specific reporting quarters.
Clinical labor inflation shows no signs of rapid reversal. Deep-pocketed rivals across home health and hospice are investing heavily in staffing, technology, and clinician retention programs that continue to push wage benchmarks higher for the entire sector.
Competition for clinical talent is fierce. Hospice providers are bidding against hospitals, home health agencies, and skilled nursing facilities for the same scarce pool of RNs, LPNs, and trained aides nationally.
Valuation is not obviously cheap on a gap trailing basis. Even near 52-week lows, the stock trades at roughly 20 times trailing earnings, which is not a screaming deep value entry point.
The balance sheet is thin. $17 million in cash after aggressive buybacks leaves limited cushion if Medicare cap refunds, a Roto-Rooter demand shock, or a broader recession hit simultaneously over coming quarters.
And if EPS misses continue into Q2 2026, further analyst downgrades look highly likely. Sentiment can stay negative longer than patient investors expect, especially when the miss streak reaches 5 quarters. The bull case opens with a structural demographic engine that is essentially impossible to derail. The baby boomer hospice utilization wave is only in its early innings of a multi-decade runway.
VITAS average daily census can plausibly grow 5 to 8% annually for the next decade, driven almost purely by demographics, rather than dependent on aggressive market share capture from competitors.
Roto-Rooter provides stable, cash-generative, non-discretionary revenue that cushions VITAS reimbursement volatility. It is an underappreciated quality asset often hidden inside the healthcare services narrative, yet it delivers consistent margins and cash every single quarter.
The buyback program at these prices is highly accretive. Retiring shares at 16 times forward earnings compounds per share value dramatically, especially when forward EPS is expected to reaccelerate meaningfully.
McNamara's long-term capital allocation track record is genuinely exceptional. 3 decades of disciplined, counter-cyclical buybacks have compounded shareholder value in a manner that most public company CEOs can only aspire to match.
At 16 times forward earnings with a 7.2% free cash flow yield, you rarely see valuation this undemanding on a high-quality, market-leading healthcare services franchise of this durability.
A historical re-rating to 22 times FY 2026 estimated EPS implies a roughly $525 stock. That would be 37% upside from today before any dividend or buyback contribution. Closing wrap. Chemed is a demographic story temporarily masked by EPS execution gaps. VITAS and Roto-Rooter provide 2 durable cash flows, and the buyback program at 52-week low prices is a powerful long-term value creation machine.
This podcast is for informational and entertainment purposes only and does not constitute financial advice. The information presented reflects data available at the time of recording and may not be current. Always consult a qualified financial advisor before making any investment decisions. Charged Alpha and its hosts may hold positions in securities discussed. Past performance is not indicative of future results.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.